Hello and welcome to our Principles of Accounting 2 tutoring session over Chapter 20. Today we're going to be talking about incremental analysis. Okay, so we just got done doing cost, volume, profit analysis. So now we're going to be doing incremental analysis. This chapter starts on page 1042. I'm assuming you've already read the chapter, so let's just talk about it. Incremental analysis, the definition is on page 1043. It says the process used to identify the financial data that change under alternative courses of action. Okay, so big picture, what we're going to be talking about is you have a choice, okay, and you're trying to decide between two alternatives. Okay, so you've got choice A, choice B. And what you're going to be deciding between choice A or choice B on what your change, increase, or decrease is in net income, okay? And then your indecision as far as this just baseline incremental analysis is, as far as principles accounting and not cost accounting, just what we're going to be talking about today is just that increase or decrease in net income and make the decision solely based on whether or not you have an increase or decrease in net income from each alternative. So, a couple definitions I want you to note are on page 1044. You've got relevant cost, opportunity cost, and sunk cost, okay? Whenever you're talking about incremental analysis, okay, and before we go any further, we'll talk about a couple of these, and they're talked about throughout the entire chapter. You've got make or buy decision, so are we going to, if we're making watches, are we going to make the face of the watch? Or are we going to buy them from someone? Okay, so you've got make or buy decision. If someone comes to you that's a dealer and says, hey, we'll give you 1,000 watch faces for X amount, but we can make them for X amount, what will be better for our company? So that's one. Then you've got kind of accepting a special price order. So that's kind of, should we take this deal or not? Let's see what else we've got. Then you've got sell or process further. So let's say that, again, we're making watches. Let's say we can make watch bands. Okay, so just the band itself. Let's say we can make those for X amount of cost and sell for X amount of price. Or we can process further and put the dial on the watch. Okay, so finish the watch. So the difference between having a band or a finished product. And then we've got joint products, which we'll talk about later on. And then another one, you've got retain or replace equipment. So if we've got a machine that we purchased for a certain amount and it's got this much depreciation, should we keep that machine? Or is this dealer that's coming and saying, hey, we can save you money and cost and we're going to sell you this new machine? Should we do that? So those are some examples that you'll be reading about and doing some homework exercises over in the chapter. But let's go back to these costs. Okay, so when you're doing incremental analysis, you're only going to be dealing with relevant cost. Okay, so in several of the examples you'll have on your homework, it'll say fixed cost does not change. Okay, so if we're making watches still, okay, if we have a fixed cost of depreciation on a machine, okay, that's not going to change whether we continue to make the watches, depending on what the machine's for, okay? So a relevant cost is something that actually changes between the alternatives, okay? So in incremental analysis, the only factors to be considered are those costs and revenues that differ across alternatives, okay? Those factors are called relevant costs. They're relevant because they change. Costs and revenues that do not differ across alternatives can be ignored when trying to choose between alternatives. An example would be a fixed cost, okay? Opportunity cost, if you've had a basic economics course, is what you give up to have another alternative. Okay, so as I make this podcast right now, my opportunity cost might be studying for another exam I have. Okay, so as I'm doing this, I'm giving up time doing another thing, which I'm not. I enjoy doing this. Okay, so opportunity cost. Often in choosing one course of action, the company must give up the opportunity to benefit from some other course of action. For example, if a machine is used to make one type of product, the benefit of making another type of product with that machine is lost. The lost benefit is referred to as opportunity cost, okay? Another example just with the watches. If we decide to make the band of the watch and the dial of the watch, okay? If we decide to make the dials of the watch, we're giving up the amount of bands we can make with the time we use to make more dials for the watches, okay? Sunk costs. Costs that are or sunk costs are, they're going to be lost no matter what. Okay. You kind of hear the old example, horse with a broken leg. Okay, a sunk cost. So let's go ahead and read what it says. Costs that have already been incurred and will not be changed or avoided by any present or future decisions, okay, are sunk costs. You've lost them no matter what. For example, the amount you spent in the past to purchase or repair a machine should have no bearing on your decision whether to buy a new machine, okay? Sunk costs are not relevant costs, okay? So if I have an old machine, like if we're dealing with replacing or retaining or replacing a machine, okay, you'll have one of those in your homework. If we're talking about that, if I have an old machine and I've had to repair it a lot, okay, I can take that idea into consideration, but the money I've actually spent on maintenance doesn't increase the book value of that machine, okay? So that's a sunk cost. So you should know how to know and understand all of those definitions. And then each of these kind of the chapter or the paragraph kind of headers are going to be exactly what we've talked about. So you've got different examples of the make or buy. You've got the repair or replace, or retain or replace rather. Oh, and then another one is eliminate a segment of business. Okay, and some of these, whenever you do the incremental analysis, you won't get the answer that you think you'll get. Okay, so one example, let me go ahead and find it. One could be if you have a contribution margin that is greater if you keep a segment of business, even though it has a loss. The contribution margin is more valuable than the loss you're getting with that business. Okay, and you'll see that in a couple of your examples. If you want to rewind and have me say that again, have at it. But incremental analysis is basically that. It's not too bad. The main things you'll be looking at are your revenues. Okay, then you'll be looking at costs. So your direct materials, your direct labor, your variable costs, same thing kind of. Your fixed costs, your shipping, anything like that. Okay. And you also have to take into account, like we said, relevant costs, something that's going to be relevant in choosing the alternatives. Okay, so one example we could talk about, kind of like a special case that I'm referring to, is if you're going to retain or replace a piece of equipment. Okay, if you sell that piece of equipment, okay, that's going to change between alternatives. Okay, if you keep it, you're not going to get any proceeds from the sale. Okay. Also, if you buy a new machine, okay, if you keep the old machine, you're not going to be spending the money you're buying on the new machine. Okay. So it's kind of, you're going to figure out kind of what your changes in net income between the two alternatives. That's the big picture. And like I said, you're going to be looking at revenues, your costs, so your variable costs and your fixed costs, your direct materials, direct labor, and stuff like that. So several exercises that we did would be like brief exercise 25, 6, 7, and 8. Those have little examples of all of those. And then, as always, your exercises for homework. So that's incremental analysis. Focus on the differences in cost and income in making a decision. Okay, so is it better for us to do alternative A or alternative B when concerning costs, revenues, and change in income? Okay, so that's incremental analysis. That's all I've got for this time. But that's chapter 20, and as always, if you have any questions, post them in the question and answer board, and we'll see you next time.